coffee
This
break,
conference will
our
now be
Commonwealth
recorded.
education series. And I think this is probably going to be our best attended webinar that we've done to date because everybody is at home. So I really appreciate you coming today. At Commonwealth, we've been working really hard behind the scenes to try to provide some solutions to our clients during this difficult time. We've come up with a list of about 6 webinars that we're going to be hosting every Thursday at 12 o'clock, so you can put it in your calendar. And this is the first of those 6 webinars. So we wanted to talk today about some opportunities that exist in the debt and financing market due to interest rates coming down recently. And I wanted to bring along Emily Mizik, who is a mortgage lending specialist that we've worked with in the past, and we've referred several of our clients to, as she's really the expert on this. I really wanted to bring someone in who could speak more to how this is actually happening day to day, what is being seen in the mortgage and debt refinancing market, and what are some opportunities that you might be able to consider for yourselves and in your situation that might assist during these difficult times. So just to set the stage a little bit before I pass it over to Emily, just a quick word from our lawyers here. I wanted to highlight some of the most recent measures that have come out of this crisis that will affect those particular debt refinancing rates that we're talking about today. So on March 19th, we had the most recent reduction to the prime rate that the Bank of Canada sets down to 2.95%. So that's the lowest that it's been in a little bit of time. The US has actually gone down much lower than that to 0, but Canada is at 2.95%. And that's the rate that the banks use to set their lending rates for the general public. And so that has caused a rate shift that Emily will talk about in a minute to mortgages and interest rates on home equity lines of credit and lines of credit. So that's something that we really wanted to highlight today because I think that's really important that people understand what their options are around some of these rate reductions that we've seen happen in the past month and how that might be able to help them with their cash flow moving forward as we all try to get a grapple on what this means for our cash flow in the short term and also for the long term. Something else that I wanted to bring up is that you may have seen this already, but there has been an announcement of a 6-month mortgage holiday that you can take advantage of if you do find yourself to be cash flow strapped. And what that really means is that if you have a mortgage payment that you're having trouble making due to extenuating circumstances, you should be able to contact your bank and be able to put your mortgage payments on hold for about a 6-month time frame. The 6 big banks have already confirmed that they are going to do this, and I've also spoken to Manulife Bank, who's confirming they are also doing this on their fixed rate mortgages. So if it's something that you think might be of interest to you, then I encourage you to reach out to your bank and consider what your options might be. So based on this, I just wanted to also just highlight, I know Emily will get into this when she does her portion, that right now I went onto ratehub.ca and I looked up what the current mortgage rates are, and there's a quite large variance between mortgage rates available in the market. This is for a 5-year fixed as of this morning between credit unions and first and second tier banks. They vary between 2.24% to 3.34%, obviously caveat that is probably just the posted rate, and that can change based on your individual relationship with your bank, but just wanted to post that for sake of interest. And there are different risks that you take on by going with different types of lenders. That's important for you to understand, and Emily is really good at walking you through what those different options or pros and cons are for those particular types of lenders. So one of the things that she's going to talk about today is it worth looking at renewing or breaking your current mortgage to take advantage of the lower rates that are available today, or is it better just to keep what you currently have? The last thing that I'm going to show you today, I just thought this was interesting, is a comparison of the 5-year fixed mortgage rates versus what the bond yields are in the marketplace. And the reason I wanted to bring this up is, we saw quite a rate reduction happen after the last financial crisis in 2008. So you can see, I got my mortgage in 2007. I paid 5.75% on my mortgage back then, which seems crazy today, doesn't it? And that really came down after 2008. You can see interest rates dipped down at the 5-year fixed. You could get it under 2% back in 2009. And if you took advantage of it then, it probably seemed great, but it continued to fall over time down to 2016 when you could get, very, very low rates on your loans. That has scaled up over the past few years. We've obviously see rates come back, but that's come down again quite sharply, especially as of late, as we've seen the prime rate come down again. So if you got, if you refinanced or got a new mortgage sometime in the past couple of years, it might be worthwhile seeing if it makes sense to either refinance or to take advantage of quite low interest rates that are available in the market today. So with that being said, I'm going to pass the controls over to Emily, and I'll let her kind of continue with this presentation since this is really under her purview, not mine. Just to let you know, Emily and I met when we were both on maternity leave a little while ago, and she's been in the mortgage sphere since 2009. She's been in banking since 2006. She's a mentor and team leader in her brokerage, and she's got a really strong belief that she can add value to clients, create really great long-lasting relationships, and really focus on educating her clients during the service that she provides for them ongoing. So it was great. Last year, she actually won the 2019 Best Mortgage Broker in Mississauga. With that, I'm going to let her talk, and she'll just wow you herself. So Emily, I'm just going to unmute you. Or if you can unmute yourself. I think I sent you the unmute request.
Are you able to hear me okay, guys?
Yep, you're
awesome.
back.
Thank you so much, Andrea.
Perfect.
That was a super kind introduction. I hope I am able to wow you. Appreciate it. As Andrea mentioned, I have been doing this for about 11 years, and before that I was in the banking world. So, my entire career I've been doing this or something along these lines. I'm a team mentor on my team with the mortgage coach, and I have a team of 10 agents that work with me, and I have 2 kids, one of which I was on mat leave at the same time or around as Andrea, and I just had one 8 weeks ago. So that is a little bit about me, and my business focus, as Andrea mentioned, is just basically to take the stress and the frustration out of the mortgage transaction and make it more of a relationship-based strategy for clients. And the way I go about doing that mainly is through connection and education. So I tend to take a little bit longer to work with my clients so that they truly understand what they're getting into, because I know that a mortgage is not a short-term solution. It's a long-term relationship whereby, you may have changes that need to be made within 25 or 30 years. So ensuring that my clients truly understand the features is very important to me, because they will be going forward with that mortgage for longer than the phone call. So it's very important that they understand and that I am able to advocate for them. So yeah, that's a little bit about me. I'm not sure, Andrea, if I go to the next slide or if you are going to. Thank you. Appreciate that. So I'll jump right into the presentation that I had in mind, and very similar to what Andrea high level did on the first slide there, is just kind of talk about rates first. So the first thing mentioned, as Andrea touched on, was the prime rate drop and what that kind of means. So rates didn't really change from a prime perspective for quite a few years. That chart actually, Andrea, was absolutely perfect, because it clarifies exactly what happened over the last 10 years, really. And what we're seeing now is banks were at, when prime was 3.95, I want to say 10 days ago, we were seeing deep discounts on the variable rate mortgages. So what that would look like is something along the lines of prime minus 0.65 or prime minus something. So you were seeing, if prime rate was 3.95, then a subprime rate, which is great for clients. So you're looking at something along like the 3.2 mark. If you're in a variable rate mortgage now and you're noticing that your payments have changed slightly, it's likely because you would notice that the prime rate dropped, so your rate actually went down to 2.2 based on that example. Now, if you were to renegotiate a mortgage today or purchase a house today, you may see the rate at 2.95 because banks, although the Bank of Canada has dropped rate and sorry, if we could go back to that awesome chart you had, Andrea, is what Ross is asking. If we can look at that one as I'm talking about it, that'd be great. It's super value add. Thank you. So the rate would be 2.95. So if you're an existing client holding a variable rate mortgage, you'll see that more than likely your rate's gone down. However, if you are applying for a mortgage today, you might notice that 2.95 is your rate. Again, still very low in relation to the conversation that Andrea started with, saying that she got her mortgage in 2007 and it was in the fives, so still low. But that's kind of where the low conversation of rates is coming from, is the prime rate dropping. So that's kind of where we are there. And then with regards to the rate hub and the 2.24 to 3.34 range, it is a quite large range on a 5-year fixed, and it does depend on many caveats, as Andrea mentioned. One of which would be the loan to value of your purchase. So if you are in a mortgage already, chances are you're in a conventional mortgage. Which means this changed in 2017, that with the stress test. And basically what that means is conventional 30-year amortization, over $1 million purchase, and 20% down. If you are in a high ratio, or what we refer to now as insured mortgage, it means that you paid a premium to CMHC, Genworth, or what is now known as Canada Guarantee. And that is between 5% and 19.99% down. And that's where you'll see that range drop. So 2.24 is really the insurable or insured mortgages with the less percent down and the lower amortization of 25 years. And the higher rate, if we can say that, is 3.34, and that is the conventional mortgage. So that's a little bit about the rates as of right now, snapshot from a variable perspective, as well as from a fixed perspective. So what that means to you from a cash flow perspective. So there's two things that I'd really like to focus on today, and that is basically what we see in front of us here, which is the HELOC, or home equity line of credit, as well as a refinance, which is the second option there. And I'll just kind of go over how this can assist clients in cash flow and giving you peace of mind. So what we're really looking at here is the best way to consolidate or to eliminate extra costs when you're making payments on your other debts. And these, in my opinion, are the two best strategies for clients, because a HELOC, or a home equity line of credit, we can actually set up without touching your existing mortgage. So that's how we basically limit the costs to be quite minimal. So what that means is we take the value of your home and we calculate what equity may be there after we subtract your mortgage. That could alleviate or allow you to access some extra funds, which you may be able to do a couple of things with. You could pay down your unsecured debts if you have credit card balances outstanding. You could allow that extra money there for pay down of secured debts as well, if you do, to consolidate. And you also could leverage this line of credit without any penalties. So it's very minimal to set it up. Some lenders charge as little as $500. Others are just the cost to get the lawyer to re-register a new charge on title. It would be a charge on title. But it allows you basically as a client to use your home similar to how you use your credit card to borrow and either pay off, or you could leverage for investments. So rainy days, renovations, those types of things. So typically I recommend a line of credit for clients who do not have an immediate need today, but do see that they may need it in the future. Or if they're midterm and their penalties are quite high to break the mortgage to consolidate, a line of credit could be a wonderful solution to take advantage. Most lines of credit, just from a rate perspective, to give you some context, are prime plus 1 to prime plus 0. So you're looking at 3.95 as of today to 2.95, depending on the amount that you're looking to borrow. So usually what a bank will do is take a look at the relationship and or what other products you have, as well as the limit capacity that you're borrowing. So typically, not all lenders are the same, but typically, $0 to 50,000, you're looking at prime plus a half. And for 50,000 plus, you're looking at prime plus 1. So just to give you a little bit of an idea. And then the great thing about a line of credit that a lot of clients really benefit from is the payments are interest only. So although you may not be paying down the principal aggressively like you would be with a mortgage, it does allow some flexibility in allowing you to have the lowest payment available maybe during these difficult times, or while you're maybe in an off season. If you're seasonally employed, for example, real estate agents may have a high summer market and a lower maybe off season, then it'll allow you to make interest only payments during that time. And then when income's higher, you can put those more aggressive payments. So there's a lot of flexibility with that line of credit. So then the next one would be taking a look at refinancing the mortgage or reviewing your existing mortgage. So I'm going to break this one down into two. And the first one I'll just jump right into with regards to refinancing your home. So same process would we would take a look at as the line of credit. We do a full application, we do an assessment to see if it makes sense, and it is secured against your home. We're breaking the mortgage or adding a mortgage if your home is free and clear, and borrowing funds and equity in your home. So why that could be beneficial is exactly what Andrea touched on in the very beginning. Rates are quite low. So in this case, when you're refinancing, you're looking at a conventional solution for your mortgage. So it would be in and around, I would say, 319 to 324, 334 today. If you're looking at a 5-year fixed, and variable, we're looking at probably around 295, which is right at prime. Again, there could be some variations there, but you cannot refinance your home if there is not enough equity, which means that you need to have 80 or 20% loan to value, or 80% loan to value, I should say, at least. So that is why it is not available for high ratio or insured mortgages, but conventional, yes. So what that would look like is basically rolling in the debt on, let's say, your credit cards, or even on a secured line of credit if you're carrying a balance for a very long time and finding that you're not able to make more than the interest only payments. By rolling that into your existing mortgage and creating a new mortgage, we can actually extend the amortization beyond the existing. So let's say you've had your home for 10 years and you originally funded it with 25, you would have 15 years left over. We can actually roll in those unsecured debts, even take a little extra out if you wanted to cover costs such as the lawyer or your penalty costs, and then extend the amortization all the way back to 30 years or to a year that you would feel comfortable with. So sometimes I ask my clients, in an ideal world, what is a payment that you would feel comfortable paying on your mortgage? And they would tell me, let's say, $1,000 monthly. And I would set the payment of that and then let them know what that looks like from an amortization perspective. So if you pay your mortgage off $1,000 as of today going forward, that would put you at 22 years, for example. And that kind of gives our clients the peace of mind knowing that they're not going back maybe fully to 30 years, but they're still rolling in the debts and at a comfortable position for their lifestyle and payment for their lifestyle. So that is basically what the process would be for a refinance. One of the other things that Andrea touched on was I do actually go over client statements all the time and tell them to do nothing, which means that you're in a really great rate, the product is amazing, and it doesn't make sense to break your mortgage. Unless you really, really want to out of personal reasons that may not come down to interest savings. It may be a different type of a goal, but I do like to isolate that and kind of clarify first. And I do that and review standard charge terms that you have in place already to see if there are any features of your existing mortgage that you could be leveraged without having to actually break the terms or take on a new product. So what that means is a lot of mortgages actually have things like, if in the past you have made a prepayment on your mortgage, you paid more than you needed to in previous years, it is possible that you may be able to actually extend your amortization back and lower your payment without making any changes to the structure of your mortgage. That means that you are, in fact, doing this extension of amortization without any costs. Outside of, obviously, you're paying it over longer, so you would have your interest cost extended, but there's no penalties or setup fees such as a lawyer or appraisal or the actual penalty quote. In that case, you wouldn't necessarily be able to add any new funds into the mortgage balance to consolidate those unsecured debts, but it could be a solution that would allow you to have a lower payment for a select period of time until you're ready to bring it back up again, or you can continue to have the payment lowered. Other than that, Andrea did mention a couple of other things that are happening right now, which are deferrals, or some lenders are calling them payment vacations or holidays. Skip a payment or rainy day features of your mortgage. This is, as Andrea mentioned, something that almost every single lender from an A or B side, which means your scheduled A banks are your larger top six, like mentioned, or the B lenders, which are often beneficial for self-employed. Those lenders are speaking to looking into options. Almost every single A lender that I work with has said in some capacity that they are offering a skip a payment or deferral program. If this is something you're interested in, I would love to have a conversation with you, because it is important to truly understand it's not simply a missed payment or a vacation as they are putting out there to the media. When you miss a payment or you skip a payment, one, you must call the bank first to do that. And I have a list of all lenders' phone numbers if anybody is interested in that afterwards on a PDF. And two, it's important to understand that the payment is added back into your mortgage, which means that you're paying interest on interest. So if it is something that you need to do, completely understand that, but please do be aware that it does impact your cost of borrowing over the term. And it isn't necessarily a vacation or a skipped payment, but it is something that is being rolled in. So the wording sometimes sounds a little more attractive than maybe what the reality is. However, it is very great that we are being offered some outside of the norm solutions in these pretty difficult times for clients. So I do applaud the banks for stepping up, but I do want to make sure that my clients and that everyone on this call understands that it's something that would still end up costing over time as they do roll it into your mortgage. Additionally, call times are quite long right now if you are waiting on hold. A lot of your lenders will actually offer online consultation whereby you can fill out a form and they will tell you within 72 hours via email or call back if you qualify and for how long you qualify. 6 months is up to. There could be shorter options if you wish, which is really great. They're tailoring it to individual clients. And that is basically the variation there. Another option I'm seeing in some municipalities, and I'm not sure if all of them have, but I know I've seen it in Halton, Mississauga, and Toronto, is the deferral on the property tax portion. And even some municipalities are looking into utilities. Some have already put it in place, so water, that sort of thing. These are all options to look into to really help cash flow solution during the outbreak that we're experiencing today. So those are kind of the three areas that I wanted to talk about, the HELOC, your existing mortgage, and refinancing into a new term. Andrea, is
Fantastic.
there anything
No,
else you
I
want?
learned a lot on that. No, that's fantastic. What I think would be really helpful is that if anyone has any questions, instead of unmuting all the lines, maybe if you could use the chat function on the panel, and just if you have any questions, if you can type them in there, and then Emily can get to them. That I think that would be the best way of handling it. Emily, what are you seeing just from my perspective? What's the main call that you're getting these days? What are most people looking at doing?
So I will say I'm noticing, quite honestly, a lot of early renewals. There were a lot of clients that renewed or had a new mortgage start in 2017, 2018. And that's when you'll have seen rates get as, I'm going to say high as, because again, you mentioned a 5% rate at the beginning of the call, but you'll see, 4.14 to 3.89-ish. And when you see rates go as low as, let's say, 2.24 or 2.34, it could be a really great opportunity to renew early without actually even borrowing more money. That also will alleviate cash flow, and that has been the bulk of my calls, I would say, this week, and even late last week. And then right now, to be honest, a lot of people will still refinance. I'm getting a lot of refinance calls saying, I was going to look into this in 6 months when it's summer, but now I'm home and I want to do my kitchen. People are refinancing to actually do renovations and future investments. A couple of my clients have even called and said, I would like to refinance today, take out money and put it into the market when things start to turn around. So it's not all doom and gloom, it seems. It looks like clients are looking to really take advantage of how things are in the market right now and see what opportunities there are for them. Now, obviously, I'm not you. I wouldn't want to speak to the investment side, but I am hearing that call quite a lot. I had 3 yesterday.
No, that's fantastic. Yeah, we have clients who have said to us, how do I come up with some cash, or what can I do if I do want to take advantage? Knowing how things played out last time we had a market correction of this magnitude, hindsight's 2020, and it is a more of a risky proposition. But if someone does have the risk appetite for that, definitely we can reach out and have that conversation. I don't see any questions on the chat function. So what I'm going to do is I think we're going to leave it there. We're just about at half an hour. So I want to thank Emily so much for her time today, for her knowledge and expertise. I'm going to thank all of you for joining in today. If you have any questions, please reach out to Emily or I. I can get her contact information to you if need be. It's on the bottom of the screen here right now. And if you do have any questions in general about your financial plan, about your cash flow, and you just want to talk about what your options are, please feel free to contact any member of our team, and we can definitely help during this challenging time. So in the meantime, I hope everybody stays safe, continue to wash your hands and stay far away from people, 2 meters, and we will all get through this together. Just to let you know, next week we are going to be doing a webinar on the inherent risks of flocking to GICs and cash during a market downturn, and what potential solutions that we foresee coming out of this. So thank you again for your attention and time, and we will talk to you soon. Thanks, everyone.
Thank you.